Hey there, future homeowners. Welcome to the Homebuyer's Best Friend podcast from Morrison Homes. We're on a mission to make your journey to homeownership not just possible, but actually enjoyable. So grab a cup of coffee, get comfortable, and let's demystify the world of real estate together. We're about to become the best of friends.
Good morning. Welcome to the Homebuyer's Best Friend, the podcast. I'm here with Ian and Trevor from Advanced Mortgages, and I have to tell everyone they are one of my favorite mortgage companies to work with. So welcome.
Thanks for having us. Thank you so much for having us.
So we have been hosting Mortgage 101 classes at many of our Morrison show homes. And if you haven't had a chance to come check one of those sessions out, but you better keep an eye out for it because they've just been so good. And I keep telling these guys, I have been in real estate for 19 years and I feel like I understand mortgages, but every single time these guys come and chat to our homeowners, I learn something new and I'm kind of blown away, especially the last one at Jody's show home in Shirako.
Well, thank you very much. It's been a very interesting time on our side of the industry. Things seem stagnant for so many years, and now they're just changing at such a rapid pace. You have to stay on top of as much as you can because what happened yesterday, changed today. So, yeah.
Has it changed? Do we have good news?
We had a rate announcement this morning. The Bank of Canada lowered their overnight lending rate by 0.25%. Very exciting.
Fantastic. So you guys also had one of the best rates that I have pitched since I saw you last week. 3.69% on a 5-year fixed. So what the heck is that rate at now?
Well, actually, the Bank of Canada announcement does not have an impact on fixed rates directly anyway.
Why is that?
Basically, that rate is the floating rate that only affects variable rates. Fixed rates are actually based on the Canadian bond market. We are kind of seeing some movement in the bond market, but we're kind of waiting for the Fed to make their announcement later and see what happens there. We do expect to see a bit of a softening in fixed rates as well. But what you tend to see happen is banks know what's going to happen before we do. They knew that the prime rate was going to fall. So those fixed rates that we were marketing, they were preemptive. The banks moved those rates down ahead of the rate announcement because they already knew what was coming.
Yeah.
So they tend to price fixed rates ahead of those announcements because they have a crystal ball that we all don't have.
Damn. I wanted one of those for so long.
But everybody that's sitting on a variable rate or a line of credit secured type of product are clapping and hopping up and down right now. They're very excited. So everything's moving down. There was projection that it was going to happen earlier in the year. They held back as long as they could. They dropped it this morning. There's even buzz about it may be happening again before the end of the year or additional in 2026. But I say that a little bit with an asterisk on it because who knows? The market's so tumultuous right now. Things could shift so quickly. Inflationary numbers and job numbers seem to be bloated and they change constantly. And that usually affects everything. Inflation affects the bond market. Bond yields affect fixed rates.
Right.
So it's a constant moving target. So staying educated and up on it is a full-time job. So
the government's balancing two things right now. They're balancing slow economic growth, which means we should lower rates, but they're also balancing high inflation, which means we should not lower rates. So they're really walking a delicate line, trying to keep the economy stimulated without, allowing prices to rise simultaneously.
But either way, we have good news today for mortgages and for all these people who are sitting on the sidelines being like, okay, I really want to buy a house, but I'm going to see how low these rates go. Would you agree that we're probably never going to see rates go as low as they once were?
Well, barring another international health incident, no, we probably won't. But I mean, rates are at a good place right now, and it looks like they're going to continue to kind of go downwards a little bit. And with this recent rate drop on the variable side, it creates a really interesting choice because, fixed rates are still sitting potentially right next to or a little lower than variable, but the variable is likely to become cheaper over the next year as that rates potentially fall again in December and again maybe in 2026.
Right.
And the other thing with a variable rate is that they are flexible. You can, if you have to break that mortgage early, it'll cost you a lot less. The penalty is typically going to be less than a fixed rate. And they're also flexible in the sense that if you take a variable, you can always lock in with that lender at whatever they're going to offer you for a fixed rate down the road, free of charge. So, you could take the variable, ride the variable train for a couple more rate announcements, potentially a few more reductions. And then hopefully while that rate is falling, you'll also get some fixed rate reductions, and then you can lock in at a lower rate free of charge.
So guess what? I just learned something new yet again, and that is amazing. Okay, so if you have a variable rate and they keep going down and you hit a rate where you're like, I think this is my rate that I feel comfortable with. I don't want to play any more risk with seeing where they go. You can lock in.
You nailed it.
Amazing.
And I mean, it's all about comfort level too, right? For first-time home buyers, we'll often say, if certainty is going to help you sleep at night, you should probably just lock in a fixed rate. We don't want you worrying about, you just bought a house, for the first time. You've got lots of things to worry about. Maybe you don't also want to be watching the bond market. But if you've got some wiggle room and you want to ride the trend and you're a little more comfortable with a bit of risk, a variable might be the best option right now.
There's two schools to that, because when you're a first-time home buyer, you're coming into the housing market, there's a lot of different variables, pun intended, that are coming at you. You have property tax, you have strata fees if they apply, you have a new mortgage payment, you have all of these new things, home insurance, all the bills that come with it. So if we can negate one of those variables from you, we usually promote having a fixed mortgage. So you can forget your rate, you know exactly what your payment is. It really helps a budget. But we also tell our clients there's really two different types of consumers in the world. There's the people that make minimum payments on their debt until it goes away, and then there's the people that log into their online banking 35 times a day. So if you are if you are the latter, maybe variable is the way to go. If you keep your ear to the ground, you keep your eye on what's happening, and you can adjust your payment up and down. You can adjust literally from a variable, like Ian said, over to a fixed mortgage if that's kind of suiting you a little bit better. So we really diagnose individual clients accordingly, and we provide the best advice that we can at that time. But with the announcement of rates going down with more to come, I think we're going to start seeing a lot more people having a variable conversation than fixed right now.
Yeah, I suspect that's going to be a pretty big trend over the next couple of months for sure.
No, when I'm hearing it, because I threw out your current amazing 5-year fixed rate to a few people, and they're like, that's amazing. I haven't seen that, because truly we haven't seen it. But then they're like, but the variables are the way to go. That's what we keep hearing. And obviously what we've just said, that they're going to keep going down. And so even though you have that really great 5-year fixed rate, people still want to take that jump and try the variable, it sounds like, just around here anyway.
I think if I was making that decision myself right now, it's probably what I would pick.
Is it? Okay. From the experts. There you go. So for us on the new home side of things, there's some new rules that we were chatting about last week that really apply to just new builds. What are those? Could you share with us?
Yeah, we've seen a few really important changes over the past year and a bit. First-time home buyers or anyone purchasing a brand new Morrison home or other new build can now access a 30-year amortization even on an insured mortgage. An insured mortgage is, of course, when you put less than 20% down. So a lot of first-time home buyers are in that boat. And extending from 25 to 30 years really gives you a lot more buying power. So really a large increase in buying power and the ability to get into more home with the same sort of economic scenario as you had before. The second big increase or big change is that you're now allowed to take up to $60,000 a person out of your RSPs to put towards your down payment, tax-free. So if you're a young couple, that's up to $120,000 for two people.
Wow.
So that's a large down payment.
Both people can utilize that.
That's right.
Oh, amazing.
The maximum is per person, not per household. And then the obvious one is that with rates falling, buyers simply have more purchasing power. Even a half-point lower rate can mean tens of thousands more in approval room, because when the mortgage rate drops, so does the stress test rate. So with these rate drops, kind of coming slow and steady, people's buying power is increasing all the time.
Hey, that's actually neat to hear, because initially I was thinking, how much money are they actually saving with this current rate drop? But it's tens of thousands possibly.
Absolutely.
So in addition to that, we have GST relief now for first-time home buyers. There's so many new things that are coming out that benefit first-time home buyers to really spur the new construction market. Usually we see these in election years, and what's unique to these is we're seeing them in the first year of a new term. So it's really exciting to see, because these look like they are viable. They're going to be around for a while, and we really love them. So as a first-time home buyer, if you're building a new home, you can save up to $50,000 in GST, which is significant. So that's fantastic, being able to factor in, and we'll get to it as hopefully down the road, but you could factor in a legal suite if you're thinking about building a legal suite in your basement, and you could use that rental income to help increase your purchasing power as well. So it's a wonderful program. There's so many neat things coming out right now, and it seems like every day something new is coming up, something exciting is coming out. So keeping your ear to the ground is a full-time job. So
yeah, and I think the cool thing for me, more so being in the new home industry, is that I sit here or I come to work every day and I'm like, we build in so many fantastic communities, and I'm like, which community should I consider buying in? Because of all this positive opportunity there is to add to your portfolio, or who knows? I feel like maybe I should leap and move to the south with my own family. But yeah, I think it's a really interesting time. So 30 years. Now, there are some people that I come across when I'm chatting with people about amortization. And again, I'm not a mortgage specialist, but they always say, well, why would I want to take longer to pay off my mortgage? And I was like, that's fair, but there's a very low chance that you're going to be in your house for 30 years. So why not take advantage of the lower payments to get you more house?
Absolutely. And I mean, your situation is also going to change. Like, your income is probably going to go up year over year as you develop in your career. So why not set the mortgage at the lowest possible minimum payment to get you into a bigger house, a better investment that'll appreciate more over time. And then you can always take advantage of strategies to reduce your amortization. So if you do take a 30-year, you can negate that very easily by making additional payments, either lump sum payments or choosing a biweekly accelerated payment frequency, or simply just artificially increasing your monthly payment. That can wipe years and years off your amortization. So set up your mortgage, with the easiest, lowest minimum payment, but then, make sure to pay more on it, and you'll wipe that 30 years down to 25 or 20 or even less. So it's all about flexibility.
I'd love to touch on that, because that's one of the most important strategies we try and engage our clients with. Just because you can purchase and afford a payment of X, it doesn't mean you have to live at that payment. So if you know that you can handle a $3,000 a month payment, you can set your payment. If your mortgage comes out and your payment's $2,200 a month, great. One thing we would say is, okay, well, you could, if you want, just increase your monthly payment and just pay $3,000 a month. Anything over that minimum payment will go directly to attacking your balance, thus paying your mortgage off significantly faster. There's other strategies like changing your payment frequency to bi-weekly. You actually make 13 months of payments in a 12-month period, which is a wonderful strategy. And another piece is, just because you can afford $3,000 a month, don't set it at $3,000, because when times are good, sure, you'll get there. But when times are tight, you don't want to have to start scraping money together to hit it. So keep your minimum payment low, just keep your contribution levels high.
Right. And you can always change that too with the banks, right? You can say, hey, for the next 6 months, I'm here, but I'm going to take a sabbatical or whatever is going on in your life. And then you can just say, go back to what we agreed to, $2,200 per month.
You can always go back down to that minimum payment, right? It's $2,200 a month. You can artificially set it higher, but you can always scale it back. Like if it's Christmas time or you're on vacation or, anything changes in your life.
Is there even a point, if you have zero intention of staying in this house for, more than 5 years, paying more, or do you just
Always?
Yeah,
your equity is always available to you. So if your plan is to stay in the home for 3 years and then move, you can still tap into that equity when you sell it through equity vehicles, such as setting up a secured line of credit behind your mortgage. So then you can pull that money out and use it to purchase your second home, purchase your next rental, purchase your next primary residence. There's always ways to do it. So there's 2 ways to really make money on your house, and that's increase in value and decrease in mortgage. So if you are really attacking that mortgage, you're achieving one of the 2. The other one just happens naturally. So,
and remember, interest is compounded semi-annually, right? So if you pay down your principal, then when the interest compounds, you're paying less interest. Right? So anytime you attack the principal, you end up saving on interest and building more equity.
Awesome. And then you can buy that second property with us, right? Yeah. Let's talk about, you touched really quickly on it, Trevor, secondary suites, because with a lot of the homes that Morrison is building in all of our communities, we have seen a lot of requests to add these secondary suites. And when you're touring all of the show homes that we're in, you'll notice that we have the option to add a door on the side of the home so that you can create that, whatever it's going to be, your mother-in-law suite. You could actually have a home business in some of those if you're a hairdresser or whatnot. Shad and Glacier has these amazing walkout lots that would be amazing for a home business. What would we'll use, since we've been up there, $600,000 home, you've got that suite, the income that's coming in for that, approximately what will that do for mortgage qualifying?
I love that you use the 600 because that's what I based my examples off of in a presentation we recently did. So it's fresh in my memory, but we're seeing so much of this now. We're seeing it with the influx of multi-generational homes. We're seeing it with the influx of people that are just looking at subsidizing their mortgage payments somehow. So the biggest benefit is, and we touched on earlier in our chat, was the new program that they have where you can actually use projected rent to help increase your buying power. So in our homework, we're looking in 2-bedroom basement suites in Calgary. They're renting anywhere between $1,300 to $1,700. There's one in Highland Park I saw the other day that was $1,700. But just for our example today, let's just say it's $1,500 a month. Okay. So you purchase a home for $600,000 and you put your 20% down. So that's $120,000. It leaves you with about $480 as far as a mortgage goes. So as it stands right now, that payment on a 5-year fixed mortgage over 25 years is around $2,500 a month. Okay. So you can either pay your $2,500 a month, which is fabulous. But if you created that basement suite, that legal basement suite, and had it cash flowing as a rental, that would contribute back to that $2,500 you're paying, roughly about $1,500. So now your net out-of-pocket expenses for your mortgage just went from $2,500 a month to $1,000 a month.
Woohoo!
So that rental property is covering approximately 60%
That's crazy.
of your mortgage payment, which is fabulous. So you can look at it and say, well, $2,500 is achievable for us to pay. Great. Well, now you're contributing a $1,500 a month payment over and above. There's benefits. A lot of these suites have shared utilities. So now all of a sudden, your property taxes are a little bit mitigated. You're paying less in monthly bills every month because now it's being split.
Right.
So it's fabulous. And if your path is going to be, well, I'd love to live in this property and then maybe keep it as a rental and move to our next property, you just turned one rental into two. So
absolutely,
if times are tight, you can move into the rental and rent the upstairs for more. If times are great, now you have a downstairs and an upstairs rental that you can keep and move into your new property with 2 cash flowing rental properties. So you just went from 1 to 3 like that.
When you might be thinking like, oh, what, I don't want to pay all that extra money for the rental suite because, there's an extra cost to create that suite. But keep in mind, we're adding all of that rental income into your application to help you qualify. So if you're thinking a $1,500 a month payment, we're adding that to your annual income. We can probably qualify you for somewhere between $70,000 and $100,000 more.
Just with $1,500.
So we're able to cover the cost of adding that to your loan, and help you qualify by including that rental income.
Yeah.
And I know it might seem scary, but if you're a first-time home buyer and you're worried about getting into the market, you're basically creating a built-in safety net for yourself. It makes your monthly budget so much more manageable, like Trevor mentioned, and you're going to build your equity so much faster. So if you're open to being a landlord, it's potentially a really smart move.
Awesome. I love it. What are some timing strategies for pre-pools and for locking in interest rates?
That's actually a really good question. We're dealing with that right now, especially with all the changing times with rates and prime and bonds and this and that. So I'm really happy that you asked it. So I'm gonna say something, and I know that I'm gonna just get absolutely lambasted for it. But when people are mortgage shopping, everybody is rate, and it is the most important thing, and I'll emphasize it again, it is the most important thing, sure, but it's not the only thing. So in addition to just having a great rate, it's not the only item you need to focus on. Prepayment limitations, how much extra you can pay. Portability guidelines. So I'm locked into a 5-year fix 2 years, so now I want to move to my new property. Can I take it with me to my new other property?
Yeah.
Or do I pay a giant penalty? Monthly annual fees for minor changes. Do I get dinged if I try and change from a monthly payment to a biweekly payment? Or do they charge me X amount of dollars if I order a paper statement? Like, there's all these hidden charges. You need to be aware of this. So having an advocate on your side, like a mortgage broker, is so important because we know the fine print. There's the things you know, there's the things you don't know, and then there's the unknown unknowns. There's the things you don't know yet, and that's really where having an advocate on your side helps, because we look out for those blind spots that you don't even know exist.
Oh gosh, I've heard so many clients over the years saying, I'm ready to buy this new house and I'm going to move forward, but I can't break my mortgage because I've got this huge penalty. And I'm like, did you not have that explained to you when you signed these documents? No one explained it. And you're just like, oh my gosh, this is terrible.
The way the banks calculate their penalties if you break out early, and we always say the quick and easy definition is, if you have a fixed mortgage and you try and break out early, there's two rules in banking: never quote the interest rate differential and never quote the interest rate differential, because it's ever moving and adjusting. So the easiest way to describe it, it's like breaking out of a cell phone contract. They just try and charge you all the interest that you owe until the end of the term. Every bank calculates that differently. So if you're digging into a bank because you want to lower your mortgage rate from 4.04 to 3.99, let's say, the perception of those savings could get eaten up very quickly if the 3.99 lender all of a sudden, calculates their penalties at some exorbitant rate.
Yeah.
So knowing all of the variables are important. Rate is important and rate is critical. And this is how you're going to win conversations around the dinner table when you have friends over. But
what are the terms?
It's so important. So when focusing on strategies, it's so much, round it all out. But when you're building a home, the big conversation about what my rate looks like when you're building a home, rate is a conversation, but it's not the factor at the beginning.
Yeah.
So all of these great fly-by-night rates you hear, I got a 1.99 interest rate, or you see some commercial for some lender that they're offering something significantly lower, 3.99. Those are usually quick close rates. So that means getting my keys, moving into my home within the next 30 days, 60 days. The standard rates, you go to the bank and say, what do I qualify for? They say, here's your rate. Those are 120-day rate holds. But when you're building a home, call it a 12-month rent time, those 120-day rates, those 30-day rates, they don't mean anything. What you need is a 365-day rate.
Yeah.
So obviously, because we're extending the interest rate guarantee out, the rate will go up. So for example, as of today, a 5-year rate we see as low as 3.9-ish, but a 12-month rate hold guaranteeing you a rate right now would be, that same rate over 12 months is around 4.4%.
Okay. Yeah.
So everybody's falling off their chairs right now and they're saying, I'm not paying 4.4. That's crazy. In our 27 years of doing this, we have never, ever had a client that paid that 12-month locked-in rate at possession. So if you think about the 30, 60, 120-day rate guarantees that we talked about earlier, we lock you in for 12 months at 4.44. And then 6, 7, 8 months pass, you get your possession letter from Morrison and they say, your home is ready, X. And if that window is within 120 days, then we start looking at tomorrow's rates. And we start looking at to see where that 120-day rate holds now. Okay, cool. We'll float your 4.4 down to 4.1. And then when we're in 90 days, we look again. And when we're in 30 days, we look again. And we do find you that rate. So rate is critical when you're building a home. Creating a ceiling to ensure that if rates go up during the build, you're protected.
You're still protected.
But when you get closer to, that's when the rate conversation becomes the conversation.
Yeah.
So it's really important. And
that's great.
Yeah. And we're in a decreasing, somewhat flat, somewhat decreasing rate environment. So they forecast maybe more additional drops in 2025, additional rate drops in 2026. So if you're thinking about the best 12-month window to look at buying a home,
buying a new home in the next year to year and a half is hands down the way to go.
And I mean, why not get the protection of that rate and have it locked in? I mean, it costs you absolutely nothing, to get your pre-approval, and it costs you nothing to get a 12-month rate locked in for you from a broker. And we probably won't end up closing with that rate. But if something does change in the world and things do go the other way, it could save you thousands and thousands of dollars. Oh, yeah. And it costs you nothing. So why would you not, take that seatbelt, have that safety net? The most important thing is to just have a strategy to get the best possible.
A good strategy. And another strategy too that I want to talk about is what type of a home are we purchasing? And being in Scirocco last week, I would like to just touch on Morrison is building many duplex and lane homes. So kind of your next move up from multifamily. There is a huge benefit that we chatted about with buying a product that does not have condo fees. And I believe you mentioned that for every $575. So if we talked about a luxury townhome that had condo fees of $500,
Good estimation, yeah.
am I correct?
You're bang on, yeah.
They're taking away about $100,000 of qualifying power, which is wild.
And if you think about it, like you could buy that townhouse, or you could buy something that's $100,000 more if it doesn't have condo fees, and then you don't have condo fees. And typically those houses also will appreciate faster. Not that there's anything wrong with the townhouse.
No, there isn't. And we build townhomes as well. However, we do have this incredible product line right now throughout all of our communities. And just the affordability factor, to get in for around $600,000 in some of these top communities, and to have a mortgage payment at the rates we've quoted in this session, around $2,400 a month, that's unbelievable. Because, a lot of people are sitting in condos or townhomes of the same price of a home that's detached or attached on one wall, and they're small.
And that's why it's such an exciting time right now, because if you haven't looked at what you're pre-approved for in the last year, you really should check again. With the rule changes, with the rates coming down, people are qualified for a lot more home now than they were a year ago or even 2 years ago.
Oh, yeah.
So that's why it's a really exciting time to look into it.
Yeah, absolutely.
Yeah, speak with one of the mortgage professionals out there. You can speak with your bank, or you can just simply Google, Homebuyer Benefits Canada, Homebuyer Grants Canada. It opens up so much more. So many people don't know the RSP increase to 60,000 times 2. Significant. It's significant. One other big piece that a lot of people don't know, and a nice little hack to take with you, is to be designated a first-time home buyer doesn't just mean that you're buying your first home. You can requalify as a first-time home buyer if you haven't been on title of a property in Canada for 4 years, or if you're going through, and unfortunately this is a reality in our world, but if you're going through a marital breakup, you're going through a dissolution of partnership, you requalify immediately for all of the incentives that first-time home buyers get. So I know it sounds like the end of something when you're going through something like that, but the reality is it's also the beginning of something new and exciting. So,
yeah, there's some silver linings.
Very much so. Yeah.
Absolutely. So let's just chat, because we're going to have you on here again, because we want to stay current with all the rates, all the things that are happening. We're going to have some new terms coming up about GST rates and whatnot, or credits. But for me, on the sales side of real estate, I always encourage people to take the time to go and find a creative advocate for mortgages. And sadly, going into your bank doesn't necessarily mean that you're going to get the best rates. Some people kind of get a little bit nervous about the word mortgage broker, but I like to share the story, and you guys can elaborate. The things that mortgage brokers can provide are there's a plethora. And one is that you're shopping all the big banks. You're going with their file to TD, to RBC, CIBC, but you're also going to all these other lenders. Tell me why it's so important to go find those very rare but special mortgage companies to work with.
I mean, a bank can only sell you a bank's products. As independent brokers, we don't have any loyalty to anyone. We just want to look at the market and see who's got the best terms, who's got the lowest rates. Sometimes it's the banks. A lot of times it's not. A lot of times it's a local credit union that, we have relationships with, or it's one of these mortgage only lenders, these lenders that you may or may not have heard of, but they do one thing and one thing only, and that's mortgages. As long as you don't care what the logo is at the top of your mortgage statement, you probably just want it to have the lowest rate and the best terms. And if you go to only one financial institution, you're only shopping that one institution's products. So, hire a broker which is free, by the way, and they'll work for you to find the best deal, and shop across the entire market. So I can't really see a downside there personally.
No, but people just get so caught on, I bank with RBC, so I'm sticking to RBC. But
So I thank you for mentioning that.
yes,
because
tell me.
This is a point of contention for me. So it's really funny, because on the mortgage side of things, the more mortgage brokers that you speak to, you'll see such a commonality that so many of us came from banks. Like me personally, I've had almost 20 years at multiple banks. One was green, one was red, and you see so many come over to this side, and adversely, you don't see so many go from being on the mortgage side back to the bank lending side.
Sure.
Just because it's a singular product. So if you bank with RBC, as you said, and you feel like, hey, RBC is going to give me the best deal, great. If you bank with TD or CIBC, BMO, you think the same, great. give them a shot, but know your value and know you have options. So either spend time online looking or speak to a broker, because as Ian said, they'll be able to offer you the best BMO rates or the best TD product. But a lot of times that product isn't the best product.
Yeah.
So diversification of your mortgage world and your financial picture is so critical. And if you have your accounts at TD and your mortgage at RBC and your investments somewhere else, that's wonderful, because then you're fully diversified. They all know that you have relationships elsewhere, so they will work very hard to keep your relationship with them or even pull it all over. But if you only stand on one leg and you have all of your investitures at one institution, it's a term in banking called fully franchised client. So as a Canadian, we're inherently conservative. So we look and we say, well, you know, I've been at this bank since my grandparents opened me up an account when I was 6. So they're going to give me all the love and loyalty.
That's my TD account. My grandma took me there and I still have that bank account.
Yeah. So
They're not the only bank that I bank with.
and when you go in and you put your card in and you put your PIN in and they bring it up, it will literally say on the screen, fully franchised client. So as a Canadian, as a human being, I look at it and I'm like, yay, I've given you love and loyalty, you know, give it back. It's the opposite. So they don't have to give you the best rate because there's no outward pressure for them too, because you have no relationships anywhere else.
That's right. Yeah.
So-
Don't know any better.
Yeah. Know your worth, know your value, know your options.
And what are the other institutions that you're able to shop people's files at?
How much time do we have?
Well,
For a minute.
a big one is like monoline lenders. And so those are the lenders that do mortgages and nothing else. There's a ton of them. There's probably like 50 of them in Canada. And people often are worried because like, well, I've never heard of this company before. Like, well, should I be worried getting my mortgage for them? I'll let you in on a little secret. All of these monoline lenders are funded by the big 6 banks. They don't want you to really know that, and we won't say which ones are funded by who, but if you do match colors, you could probably figure it out.
On the next podcast, we'll give a long list.
We'll go into it.
We will not. Yeah,
But those lenders, because they don't have brick and mortar stores, they don't have, you know, retail locations, they don't have all these other costs and overhead, they're able to lend you money at a better rate with better terms, and basically get you a better deal. I mean, go to your bank, get a quote, but get a quote from a broker too. It does not hurt to get a second opinion. And in fact, on the largest decision, you know, financial decision in life, I would say a second opinion is probably a good idea.
And it doesn't hurt their credit, right? By going and shopping a couple times. Am I correct?
You are correct. So if a client was to take, say, a week off of work and have the same conversation at every bank throughout town and do applications, individually, they will pull your credit and you'll have multiple credit hits.
Yeah.
Working with a broker, we will pull your credit one time and discuss it with all the lenders. So it saves you it saves you a week of having to go and have the same conversation with strangers, but it also saves you all those multiple hits as well. One thing that Ian spoke of that I want to chat about is that monoline bank. So the one thing I always try and weigh rate and value to savings and interest and all that to like human value and human cost as well, because what I really love about these monoline lenders, they're a monoline, they have one product line.
Yeah.
So they basically, if you have any account, any investment, anything at any bank, you know that their job is to cross-sell all their other products on you. So every night when you're at home trying to make dinner for your family, the phone's ringing off the hook and they're trying to sell you an RESP or a credit card or this or that or whatever. So these monoline lenders have one product line. And what I love about them is they give you a fair rate with incredible terms and great customer service and a web portal you can log into if you want to check, or a number you can call if you have any questions. And then they basically just shake your hand and
talk to you in 5 years.
Talk to you in 5 years.
Yeah.
And it's so wonderful. And it just saves so much noise and so much cross-selling. And I love avoiding those things, and it just creates peace in my world when I'm trying to have dinner.
And that's what we're all seeking for, hey? Happiness,
Exactly.
peace, and a beautiful home to hang our hats in. Well, let's just end it here for now, because I'll be bringing you back in the next month or two anyway. For anyone that hasn't actually come across you guys, where can they find you?
You can find us at advancedmortgage.ca. I'm Ian at Advanced Mortgage. Trevor's Trevor at Advanced Mortgage.
You can find us on Insta, all the social media channels.
Awesome.
Yeah, please come say hi.
Yeah, no, please do, or come visit one of our upcoming Mortgage 101 sessions at Morrison Homes.
We would love that.
Awesome. See you soon.
Thanks for having us.
That's all for this episode of the Homebuyer's Best Friend podcast from Morrison Homes. We hope you've walked away with some great tips and a little bit more confidence for your home buying journey. Don't forget to subscribe so you don't miss our next episode. And if you have any questions, you can always find us on our website at morrisonhomes.ca. Until next time, we're Morrison Homes and we'll be your friend through every step of the process.